There's just so much bad information from lending to markets. There's some fear mongers out there. Take everything with a grain of salt. When something piques your interest, really dive in and use more than one source to analyze that market.
It's my great pleasure to welcome Parker Borofsky to the show. Thanks for joining me today. I can't emphasize how important it is to have a mortgage lender that you know and trust, and it's a huge superpower in scaling a short-term rental business. So how does a loan actually work within your firm broadly?
So my first glance is, okay, does this fit the box? And then if for some reason it doesn't fit the box on the surface level, my next thought process to myself is, okay, but does this make sense?
The market was down year over year from a very healthy level in 2022. What are some suggestions that you have for investors as they're looking into the market now? Like, what should they be doing to prepare themselves?
Yeah, great question. So
welcome back to STR Investors. I'm your host, Michael Chang. It's my great pleasure to welcome Parker Borofsky to the show. Parker, thanks for joining me today.
Thanks for having me. I'm excited.
I'm super excited for Parker to come on. I've known Parker now for almost 4 years. Parker has done all of my loans, the 6 short-term rentals I own in Tennessee. Parker has done all of those loans. So she, I believe, is one of the very best out there, mortgage lenders out there. So I'm super excited for this conversation. I can't emphasize how important it is to have a mortgage lender that you know and trust and work with. It's a huge superpower in scaling a short-term rental business. So I'm really excited about this conversation today. So Parker, thanks for being such a joy to work with.
Absolutely. I don't know about joy, but
As joyous as a mortgage underwriting exam can be. But
yeah.
now there's some things I definitely want to highlight as we go through this. But before we start, Parker, and I think part of why she's so good because she is also a short-term rental investor, and she has a really, really cool short-term rental portfolio spot with like peacocks, which I love the story. So Parker, why don't you tell us a little bit about, why don't you introduce yourself and tell us about your peacock farm?
Sure, absolutely. So my name is Parker Borofsky, and I specialize in short-term rental lending for clients out there to help them grow and enjoy the successes that my family's been able to enjoy from this. So yeah, so our peacock farm is an interesting story. So we have 12 short-term rentals total, but 5 of them are actually located on the property we live on. And so we accidentally found it, which is always the best way to come into these things sometimes. So we were actually looking for just a primary home and saw a listing, and it was a 5-bedroom log lodge cabin, and it also had 2 studio cabins with it on the river. And so our initial thought was, hey, well, why don't we buy that? We can live in the 5, not that we need a 5-bedroom, but it sounded cool. And then we could rent the 2 studios to pay for the house. And at this point, we had 2, or actually, I guess we had 3 other short term rentals at the time. And so we had some faith. We knew how that process could go. So we came to see it and then quickly realized that it was one parcel of a much larger. They had just split it. It was all one before. It sat on the market for a year at 2.2 million. Nobody purchased it. And so when we came out here, we realized there were 4 different parcels to purchase. And we fell in love with the property. It's on the river in Townsend, Tennessee. There's a historic swinging bridge that crosses the river. And so from directly from our property, you can go right into Townsend. And so we just fell in love. So there's a 1930s cabin. It's a 3-1. And then our house is like a modern metal house. And here's a tip for people: bad photographs are the best. Like, there are terrible photographs of this property, and we get out here and it's like paradise. And these metal looking houses that look a little awkward from the outside are gorgeous on the inside. They're only 3 years old, and there's 2 of them. So we live in one and we rent the other, which is our best performer. And then the 2 studios and the 5-bedroom lodge that sleeps 22 people. So we fell in love with it. That was February of 2020. 2 weeks before closing, COVID hit the US, and nobody knew what was going to happen at that point. And so we're like, well, I guess we're going to go big or we're going to go home. This is either going to be fantastic or really, really bad. So we went for it, and it's turned out to be phenomenal. So now we have a little peacock farm. My husband, I never knew until a few years back that my husband really liked peacocks. And so there was a stray peacock wandering around our old neighborhood one day, and our neighbors called and said, "Did you guys get a peacock?" I was like, "No."
No.
So we went out. My daughter sat there for like 5 hours waiting for it to come out of a tree. She had some neighbors help her wrangle it up. And so that's Pepe, the peacock. And then we purchased a female peacock. And since then, they've had baby peacocks, peachicks. So now we have seven on property. And then we also have four goats. I don't know if you knew that.
I didn't know that.
Yeah.
That's
So the
awesome.
guests they love the peacocks and the goats, and we just had a baby goat. Our goat had a baby on St. Patrick's Day, so we named her Clover.
That's awesome. That's amazing, and a differentiation of the property. You can advertise like peacock. I mean, it's cool. Like, I'm sure it attracts a lot of families. I know my kids would love to go to a peacock farm and look at peachicks.
Oh, yeah.
Um, that's really really neat. And like, I'm sure that properties performed really really well, given
Yeah,
you bought it pre-COVID and then been a beneficiary of the COVID boost in the Smoky Mountains market.
absolutely. Yeah, it does great. Yeah.
The I was introduced to Parker through my broker, through Avery Carl and her team at the Short Term Shop. So shout out to Avery as well, for introducing us to the market and introducing us to Parker. And we had an atypical background, right? We weren't W-2. I had already left my job. My wife and I were self-employed, and we had the rental arbitrage business, which you know is not the most straightforward income profile that a mortgage lender has seen. And I talked to a few mortgage brokers before, Parker and I kind of hit it off. And, what I really liked about working with you was like, you really took the time to like understand like our situation and, I think to advocate for us. I don't want to say fight for us, advocate for us internally. So I want to kind of unpack that a little bit because I think there's a lot of mystery around like the mortgage process. Maybe just break down the plumbing a little bit for us. Like, we're speaking with you, but obviously you have people inside your organization that are part of this process. So maybe spend 2 minutes and how does a loan actually work within your firm broadly?
Yeah. So I work myself and my team, we work for Movement Mortgage, which is a national lender. I have recently, though, I'm excited to say, created our own group within Movement Mortgage. So Wealth Builders Mortgage Group is my team. And we specialize in challenging situations, short term rentals, and so forth. And, when it comes to mortgage, there's a few ways, and every loan officer is a little bit different. There are some that really, a loan officer is an interesting position to be in. On one hand, like you said, you're an advocate for the consumer. On another hand, you're supposed to protect and follow the guidelines and loan process. So when it comes to underwriting, what a lot of people may not realize is that in most cases, the underwriter's job isn't necessarily to judge you as a borrower and say, yes, I believe in this person, or this one looks a little iffy, right? The underwriter's job actually is to protect the mortgage company from not following guidelines and incurring a buyback. So if we underwrite a Fannie or Freddie loan, Fannie Mae or Freddie Mac backed loan, there are guidelines that we have to underwrite to. And so if we don't follow those guidelines, that loan gets sold to Fannie and Freddie. And they do audit a lot of these loans. This is not like the IRS where it's like, one out of 500,000 gets audited. No, they audit quite a few of these loans. And so if a guideline wasn't followed or underwritten correctly, they can force a buyback on that mortgage company that originated, and that costs the company a lot of money. So this is where two things come into play. Number one, that's what the underwriter is underwriting to. They need to make sure that it meets the guidelines, or if there's something in the gray area, that it's an acceptable and explainable reason. That's where a good loan originator comes into play. When I have a situation, the first my first go-to is take a look at the income docs if they're self-employed or the the circumstances, if it's a bonus situation or RS, somebody's getting restricted stock from a company. There's so many different layers and levels. This is why AI cannot take over our jobs right now. It's a little too subjective at times. Um, my first glance is okay, does this fit the box? And then if for some reason it doesn't fit the box on a surface level, my next thought process to myself is, okay, but does this make sense? Knowing what I know, knowing this person's in, and if to me it at least makes some sense, that's where I'll go digging in, just to read. I still, even at my level now, I mean, I've been the number 17 loan originator in the entire country. That year we closed 323 million in volume. But even at that level, I still go back and read guidelines every day because sometimes they change a little bit. Sometimes there's updates, sometimes beneficial, sometimes not. But if they're not, we got to find another workaround. So yeah, so that's how when somebody comes to me, first we look at the boxes and explain how that works, and like I said, if it makes sense, we really try to get it in play. And I'm trying to do more educating clients as well.
Yeah. I think that's really important, right? Like break down a few things that you touched on there. I think one is, when you talk about the underwriting process, so where once we apply for the loan, I'll be able to submit all these documents to your company, or any borrower will have to do that. And then the underwriter's job is, you're right. So it sounds like just to make sure that based on, certain guidelines they have, like what we provide hits those guidelines. Because what you don't want to do, or what the firm is trying to avoid is, if it doesn't follow those rules and then you incur some type of penalty from the people that buy the mortgages, and then that's bad for, I guess, bad for the underwriter, bad for the team, bad for the company. Okay, well, what else do you have that can like maybe fit the box or address it in a different way? And three, actually like following up with underwriting and making sure that they see it and hear at least a different perspective. Is that maybe the right way to think about it? Versus maybe someone that, a lender or a mortgage broker that isn't taking that next step to educate both on the borrower side and the internal side.
Yeah, absolutely. So part of that underwriting process, like I said, there is some gray area in the guidelines. Not everything is really cut and dry. And so that's where, just like doctors aren't all the same quality or level. I don't want to say quality, but some doctors are a little more knowledgeable than others, or attorneys maybe a little more talented than others. So same thing when it comes to lender, not, not everybody thinks through things the same way. That's where you want a talented loan originator who's able to put the pieces together, but they also have to sell it to the underwriter, and they have to make the underwriter feel comfortable that, hey, if this is questioned by Fannie or Freddie or whichever investor this goes to, if they come back and question this particular section that was underwritten, do we have enough data to back it up and explain why we did it this way? And so I tell people all the time, I'm not a salesperson when it comes to selling clients. It's more about selling the underwriters and giving them something where they can be comfortable if we need to deviate a little bit from the norm.
Yeah, no, and peacock a little bit for us. Number 17th originator in the country. Like, tell us about the fabulous year you had.
So it was 22. Yep, absolutely. Just insane. So I think it was number 26 the year before. I can't remember. I closed 304 million in 21, 323 million in 22. It was just insane. And that was myself. I do have a senior LO on my team as well, Rob Breckenridge. He's amazing. We just started a junior LO, Casey, to help clients as well. And then I've got a fabulous support team at Melissa and Lisa, which if any of you out there have done anything with us, I'm sure you're familiar with them. They're amazing. So, but yeah, that was just it was like not sleeping. That was maybe 3 4 hours of sleep a night that year.
You can sleep during the bear market. How's that?
Yeah, yeah, and it did, then when rates kinda went up, businesses slowed down quite a bit, but it's okay. It's given me time to be more public and educate more people, so I'm excited about that opportunity.
Let's talk about that actually, right? I think there's a lot of people right now. I mean, you just quoted me a 7.375 rate for a simple product, like, and then the first mortgage we did together was in the twos. So rates have come a long way since, you and I started working together.
So, yeah,
So, tell us like what's going on in the mortgage market, Parker? Why
great
are rates so high?
so that's a great question,
Why are rates so high?
because I'm just kidding. So the what's happened is the mortgage-backed security market. So it has a little bit to do with the Fed, but it's not directly tied to the Fed. And I think that's really important for people to understand because some people are waiting for rates to drop and they're watching and waiting for the Fed. But rates have already dropped significantly since they peaked in October. And so I don't want people to miss that fact that rates have already come down quite a bit from their peak because they're waiting on the Fed to drop rates.
So let's pause. Let's pause there. I think that I know the answer to that, but I think people are going to lose that nuance, right?
Sure.
Rates peaked, right? The Fed funds rate peaked at 5.25. I forget now, like October-ish in 23, Q4 23. The Fed has not cut Fed funds rate. We're recording this April 9th, 2024. What rates are you specifically mentioning that have dropped since?
Thank you. Yeah, more the mortgage rates, the secondary market mortgage rates. So your traditional Fannie Mae, Freddie Mac loans or jumbos as well. Yeah.
What were they back then at the peak versus what are they now? Like, what's this? Just to give people a sense of like how much they've dropped since.
The easiest to explain is primary home rates. Now, primary, second, and investment, they're all on the same scale, but the easiest to kind of visualize would be the primary home rate. So primary homes they peaked around 8% in October, and currently they're running 665, 675 is where they are now. I think they've gotten down to about 6.375 and then they bump back up a little bit.
Okay.
But that's where they're hovering now.
So when the Fed has not cut rates, why have those rates dropped? Point and a half.
All
Well,
right,
1.5%.
I'm gonna really nerd out here.
Do it.
All right. What happens when a mortgage lender or a broker originates a loan is that let's talk about Movement, for example. So Movement Mortgage as a lender, that means they underwrite, they fund at closing. And so we underwrite a loan, we fund it at closing. Well, that money, so Movement doesn't have deep enough pockets to fund, billions of loans, right? And wait 7, 10, 30 years for those to be refinanced or paid off. So what Movement does after closing that loan is they will sell it to the investor. So let's just say it's a conventional loan. So we'll turn around, sell that loan to Fannie Mae. Movement gets its money back so that we can go and lend again on another property.
And that's where a mortgage company makes its money, right? Because there's a difference, there's a spread that you make, and that's the profit, right?
There's a margin.
Right.
Yes.
There's a
Yeah.
margin. Okay, got it. Okay, so you originate the loan. So I have $1 million mortgage. You're giving me $1 million to go and buy the property, right? So it's $1 million out of your pocket. And then what you're saying is that Movement doesn't, or most companies don't have billions of dollars to wait 30 years to get their money back. So they take that mortgage, they sell it to an investor like Fannie and Freddie, and then Fannie and Freddie will say you'll pay them like $1,010,000 as an example. So Movement makes a little bit up there, but then they get most of that money back so they can re-lend it again and then kind of redo this process over and over again. And that's the business model.
Yeah.
Correct?
Mhm.
Okay.
Correct.
Okay.
Yep. So now you have, and this is actually why Fannie Mae and Freddie Mac were created. They were created to be the vessels for these loans. So Fannie Mae doesn't have deep enough pockets to sit on all of these loans that they're purchasing either. And this is where they'll bundle them together into what is referred to as a mortgage backed security. And they'll bundle similar loans together and sell them on the secondary market called the mortgage backed security market, which essentially is the stock market for mortgages. That's basically what it is. So for easy math, and this is where points come into play too, by the way. So for when you get a loan and if you pay points, this is where this comes from. The discount, because I've always wondered why do they call them discount points? I'm not getting a discount. The company's not getting who's getting the discount? Well, it's the investors at the end of the food chain here. So what happens then is Fannie Freddie take this mortgage, they go sell it on the mortgage-backed security market, investors purchase, and these are big loans. So these are, lots of loans bundled together. So these are really high dollar. On a small scale, though, let's just say you had 10 loans at $100,000 each. That mortgage-backed security would be worth $1 million. And so we'll take it, and the investors, like maybe these are investment occupancy. So the investors may say, "Oh, okay, we'll buy your $1 million mortgage-backed security, but we only want to pay 950 for it." Well, Fannie and Freddie need to sell the loan because they have to continue that liquidity, and so they'll sell it. So at 50,000 is the discount to the investors, and that's where the points. And so Fannie Freddie anticipate that pricing, then they may pass points to us, and we pass it on to the consumer. Which points still haven't been a thing for primary homes, but they have been for second home and investment for that reason.
Got it. So let me play that back just so that I understand it properly, and hopefully the listeners may hear it twice. It's going to be helpful. So when Fannie and Freddie, or when an investor, so when the ultimate investor buys it, they will want a discount. They want a discount to the face value of that mortgage, right? So say that mortgage-backed security, right? The face value is $1 million. They only want to pay 950,000. So there's a $50,000 that Fannie and Freddie are out, right? And then so they're anticipating that. So that's why they're making the borrower pay 1 point, 2 points, whatever on the mortgage, because they know that they're going to have to give up these points to ultimate investor. So that's why they're charging us. So that's why you're
Correct.
charging us. So
Yeah.
is that why, like, you can't just, like, sometimes, like, we have to pay points, and, like, we can't just get a mortgage that has a high enough rate that can justify that? Is that a reason why? Because there's mortgages where you're like, well, we can't offer a no point option. Like, you have to pay points.
Yeah, and that was not a thing before rates skyrocketed, or at least it hadn't been since I had been in mortgages. And so what happened was, I believe what happened was that mortgage rates shot up so quickly, and the investors at the end knew that rates eventually were going to come back down. People would refinance. So here's the other piece of that puzzle: when the investor buys, let's say, those 10 loans, right? If those loans are, if somebody sells a property or refinances that, well, those loans disappear from that mortgage-backed security, and the investor's no longer making interest on those. And so part of it was that investors didn't, there was no appetite for these loans for them to do, 9.5%, because they knew for a fact people would refi probably 2 or 3 years later. So the points were a little bit of security as well in being able to get their interest paid to them upfront. So it was a twofold. One, it would take longer for people to want to refinance. And two, by getting that discount, essentially they're making some of their interest
Yeah.
upfront.
So they're making the
Yeah.
money. So they're getting the money up front, and the lower the interest rate, right? The lower probability a person's going to refi as the
Right.
loan goes down. Because that makes sense, right? So if a
Mhm.
loan is 15%, then the first opportunity someone's going to try to refi down. But so I just want to go back to the original question of, like, so why have mortgage rates come down? So now we've talked about the plumbing now
Sure.
of how it goes from borrower to the ultimate investor, and then there's, like, 3 or 4 people in the middle there that makes all this happen. Why have rates come down and Fed has not cut rates? I mean, the Fed has held rates up to now. Why have rates dropped in anticipation?
Thank you for coming back to that. So the reason for that is, so these same investors that purchase the mortgages are the also investors that purchase the 10-year treasury. The reason that these are the same type of investor interested in the mortgage-backed security market is that it has a similar lifespan as a 10-year treasury. So mortgages traditionally are about 7 to 10 years in their lifespan, same as that 10-year treasury. So as the 10-year treasury increases and decreases, that's what pushes the rates, because the 10-year treasury is less risky. It's a little more solid and stable than the mortgages. So interest rates on the mortgage-backed security side have to be higher enough for it to entice these investors to purchase mortgage-backed securities instead of the 10-year treasury.
Aha. There's
Yes.
a tick. That's a ticker. So For
Yes.
us as investors or us, us as real estate investors, so what we really should be looking at is the yield on the 10-year treasury note, not the Fed funds rate, right? Not the rate that is quoted in the news media a lot about, the Fed cutting rates. It's what the US government debt, the 10-year US government debt, what that's trading at, the direction that's trending, that really is going to have that's going to be much more impactful on mortgage rates than the Fed funds rate.
Correct. Yeah. And what the Fed does and what they say will have some impact on that 10-year treasury just because that's all it's like the stock market, it's emotional. And so it's a sentiment, are people feeling good about the economy or not? And that I believe, and correct me if I'm wrong, you may know more about that. That's really that sentiment is a big driver of the 10-year treasury.
Yeah, yeah. No, I mean, you're absolutely right. It is emotional and it needs to calm down. So, I can, I don't know, it keeps moving away from me. It's widened over the last week here just because, we had this really strong jobs report. And now people are saying that the Fed's not going to cut three times. It might cut two, might cut one, might not cut at all in 2024, which, is being priced into the 10-year treasury. And that's why the 10-year treasury is going up. And which is why my mortgage rate is quarter to three eighths higher than it was when it was quoted to me 2, 3 weeks ago. So
Yeah.
that's so look, I mean, it's not. I guess it's no one's quote unquote fault or anything. It's just market. So when you go buy a house, right, when you get quoted a rate, that rate continues to move until you lock it in, right? Until you get that contract signed and you do what you need to do with the lender until they lock the rate. It's not locked. It's not locked until it's locked.
Right.
Um,
Right.
and Parker, remember you and I, we had that situation with property number 6, I think.
Okay.
And it was like, I remember I was sitting in Philadelphia. We had just ordered takeout after like a long 2 days of working. And we're like talking to you about the loan. And I was like, we didn't lock it. It ended up being fine. It was like just a little slightly off. But yeah, folks, make sure you lock your rate. Make sure you like everyone knows like when you want to lock the rate, you lock the rate because yeah, it's a moving target. Luckily for us, it didn't have a too big of an impact. But in
Right.
markets like this, it can get away from you pretty quickly.
Definitely. Well, and
I
it
forgot
can
about
go
that
the
actually.
opposite. Yeah, it can go the opposite. You might lock it 2 weeks from now, and it could be back to where it was. Nobody.
Exactly,
Yeah.
exactly,
Yeah.
exactly. So then, yeah, so it's just like, you have to, there's a little bit of like the luck of the draw, like, because you can't wait too long for a rent lock because your contract, you have to get a mortgage commitment at a certain time,
Mhm.
like if you have a mortgage contingency. So you
Right.
can't wait forever. So yeah, you're kind of, if the mortgage moves by a quarter point and your deal is bad, then you probably shouldn't have done that deal in the first place. Like it can't, it should be that tight where if it moves a little bit, then it's a bad deal, right? Like,
Yeah.
the deal should be able to stand on its own 2 feet, irrespective of if a rate is quarter or half a point, right? If it's that tight, then you really need to look at your underwriting and make sure that's done properly.
Yeah. Definitely agreed.
Thank you for going through all that with me. And I love nerding out on this podcast. I think
Yep.
everyone enjoys I think that's what we try to do here is just like educate, that it's not just like the high level. Like I want to really get down to the details and on why, because I think the details really matter here, right? The more you understand
Yep.
about this process, the
Right.
more educated, the more empowered you'll be when you're talking with a lender, with a mortgage broker, like, you just understand, like, what the pieces are versus being like, "Oh, well, yeah, like, I talked to this person, now I'm gonna get a loan." Like, no, there's, like, 4
Right.
or 5 people that need to kind of, like, sign off on this too. Now, short-term rental market, like, have you done fewer loans this year since, rates have gone higher as activity slowed down?
Yeah. I think. Well, last year we did for sure. We closed about 120 million last year compared to.
Still really good.
Oh yeah, no, fantastic. But compared to the previous years, definitely a different landscape. But I have seen an uptick this year. I think maybe because those rates have settled down a little bit and people are picking up on that. I also think last year was a little bit of an anomaly itself in the short term rental market. Most because I've got a pulse since I lend in all over the United States and a lot of different short term rental markets. I've got a pretty good pulse on what's going on. And I'd say in most markets, people were down about 10-15% in revenue, including us. And I spent a lot of time talking to a lot of people trying to figure things out. And what I finally came up with last year is that there were two things. One, I think people were getting squeezed by inflation and what was going on in the economy. And then two, there truly was a ton of European travel. So I read an article, and I'm pretty good about, sourcing. I don't believe everything I read. And so I read an article about, record breaking European travel. And so I reached out to a travel agent client of mine just to get her take on that. She's been a travel agent for 20 plus years. And she confirmed, she said, "Oh, it's insane. Like flights are oversold, hotels are jam packed. If you don't need to go to Europe, just don't. It's not as fun as it normally would be." So, yeah, I think there's a lot of that going on last year. And I feel like, even especially as an investor myself, I definitely feel that has shifted back to more normal so far
Yeah,
this year.
it definitely was a more transition year last year. I think there was just a lot of uncertainty, just didn't know, like, where things are gonna shake out. There was all this talk
Yeah.
about recession and Airbnb bust. There was all this, like, there was all this noise, and I think ultimately the market was down year over year from a very healthy level in 2022. And I think this year, at least for us, it's been flat to slightly up. We were down a little bit year over year, but not that bad. And I think there's just a little more. This is a little more like maturity in the market too, a little more stabilization. You're like, okay, like I think people were just. I think it was just like there's such a doomsday kind of feeling of 23
Yeah.
because no one knew what
Yeah.
was going on. They were like Feds are going to raise rates and all this fun and all this stuff. There's still like kind of this COVID scare too that like there's a new variant and all these bad things are going to happen. None of it did. The economy is still really strong, like 300,000 jobs. Last month. So I think just like okay, like with higher rates, but like you're just more certain on the revenue side, which is just speaking personally, that's giving us more confidence to buy the first short-term rental we bought in 20 months now. And the last time we closed is August of 22. So it's been
Okay.
20 months for us. We've still been active on the rental arbitrage side. So, and that's for a different topic, but I think it's good that as a short-term rental investor having different tools and tool set. So like when things are different, you have the right tool for the right situation. You're not because you have a hammer, then everything is a nail kind of thing. Right.
Right. Yeah.
So as we went into conversation, Parker, like what are some suggestions that you have for investors, like as they're looking into the market now, like what should they be doing to prepare themselves?
Yeah. Great question. So, a couple key things I would say. Number one, don't listen to half of what you read in forums and online. Highly encourage. There's just so much bad information from lending to markets. There's some fear mongers out there. Then there's some and again, having a good pulse on a lot of these markets, investing myself and being a loan originator, especially specializing in this, some of that drives me nuts. So I would say take everything with a grain of salt when you read that information, and then when something piques your interest, like really dive in and use more than one source to analyze that market. Don't just look at AirDNA. I mean, AirDNA is a great place to start. Sure, see what it says. But I would double check that with STR Insights. There's a new app called STR IQ Strike. That's a really great one. So if you start comparing and see that they're all lining up, that's a good sign. But if some are really off than others, you know, maybe dive in a little deeper.
What do you like? What do you like the most? Like, do you kind of take all three and just take the average? Like, what's your process?
So I'll look at those just to get an idea. But like I said, I have a really hard time trusting anything I read necessarily without diving deeper in. So, like, I had a client actually earlier today who sent me a property they wanted to buy on a river in Florida. It was west of Tampa. And to me, when I first look at the picture, it's a cute house, but I see a river and trees and bugs. And when I go to Florida, I'm going for the beach. I'm not going to be on a river with the mosquitoes.
Yeah.
And eh, you know, so I questioned, I was like, well, hey, what drew you to this one? And he said, oh, well, the AirDNA numbers look great. So, my next question was, well, what brings people to, because it's a really small area too. I was like, well, is there a big driver for tourists in this area? What's going on? And they didn't really have a feel for that. And so I encouraged them. I said, hey, this could be amazing, but I really encourage you to find out what the market drivers are here. Because sometimes AirDNA just has some outlier. Maybe there's just
One
one
property.
short-term
Yeah.
rental
Yeah.
in the whole area. And, so I also question sometimes where those apps get their data from, but we've got actually our best performing property from a ROI perspective, consistently does about 120 a year. But if I look it up on Airbnb, it'll show 79,000. So that's where I question, okay, where is all this coming
Interesting.
from?
Interesting. Yeah, I
Um,
no, I think that's it's great to check various different sources and really kind of and obviously understand the market. Just relying on one source. We use our day fair amount. We also kind of look at the comps, and you want to find like again multiple comps that
right,
triangulate to that number. Other providers obviously important as well, but also just like to your point, like common sense too. Like and it's kind of harsh, but like zoom out a little bit and then just like, so why are people coming here? And yeah, like,
right,
yeah, like,
yeah,
the people that want to hang on the river, like really going to be like pay that ADR, right? Because it's like a little bit of sense checking instead of just being the slave to the numbers. Cause again, it's just like, obviously it's one data point, but like you really want to understand like why, right? Like why do people come here? Is it like, is there a long-standing history of people coming here, right? Is what they're coming here for going to be here for like 30 years, right? It's your mortgage. Um, right? Like those are like really important questions to answer. So that's a good recommendation. If you want to find you and talk to you and pick your brain, what's the best way for the people to find you?
absolutely. So the easiest way, we can find me on Facebook, just DM me, or at wealthbuildersmortgage.com. I know it's a mouthful, sorry, but wealthbuildersmortgage.com. And that is our team website and also has our contact info, and you can schedule on our Calendly app on there as well. So,
Perfect. We'll drop the link in the show notes. We'll make sure we spell it correctly so that it goes to the right link.
yeah, thank
Um,
you.
but no, Parker, thank you very much for spending time with me today. Really appreciate your breakdown of the markets, and for folks out there, like Parker really is a tremendous resource. So if you're looking to buy a house, you should talk to Parker.
Thank you.